Hello, everyone, and welcome to today's webinar on year-end charitable giving options. It's not too late if you act soon. My name is Panita Khanna, and I am Director of Community Relations at Dr. Susan Love Foundation for Breast Cancer Research. For those of you who are joining us for the first time, I would like to take the opportunity to introduce you to our organization. Dr. Susan Love Foundation challenges the status quo to end breast cancer through innovative research and improve the lives of people impacted through education and advocacy. We drive collaborative, cutting-edge research with non-traditional partners, shed light on the collateral damage of treatment, and actively seek ways to diminish it, and interpret science to empower breast cancer patients. But we cannot do this work alone. As a nonprofit organization, our work inspires individuals, corporations, and foundations to join us in our breast cancer initiatives. Today's topic, year-end charitable giving options, continues our efforts of offering our supporters a variety of opportunities to support Dr. Susan Love Foundation. This webinar will be recorded and will be sent to our attendees within 2 business days and will also be available on our website. If you have any questions, please enter them in our Q&A, and we will get to them time permitting at the end of the presentation. And a disclaimer before I turn it over to Jane Schroeder from Lennox Advisors, who many of you may remember presented a financial webinar for us over the summer. This webinar is not intended to provide investment or legal advice, but instead to inspire and empower you to plan your charitable giving options. Jane is a breast cancer survivor, a friend of the foundation, knows the importance of year-end charitable planning, and has worked with Jim for over 30 years. Welcome and thank you, Jane.
Thank you, Panita. Once again, I'm Jane Schroeder, and I'm a breast cancer survivor. I am proud to be here and to be a friend and a supporter of the Dr. Susan Love Foundation. Today, I've got the distinct pleasure to introduce all of you to a very good friend of mine, Jim Normandin. Jim has been a specialist in the charitable giving space for well over 30 years. He is excellent and a true expert in this field. He's one of the top in our country. I am honored to introduce Jim today and so happy that he can be such an amazing resource for the Dr. Susan Love Foundation. Take it away, Jim.
Hey, Jane, thank you for that wonderful introduction. My mother would have liked that. So my assistant today is Bailey, and she's going to be controlling the slides for you today. So let's go to the next slide, Bailey. This is my little addendum, if you will. And I believe the strategies that I will be mentioning today, properly employed, represent a tax-wise way for you to give more to the Susan Love Foundation and or any other public charities. This information is universal, if you will. Okay, Bailey, next slide. So what can be gifted and qualifies as a charitable deduction for any year, for that matter? Well, just about anything you can imagine can be done in Can it be done in a timely manner? You bet, with enough time committed. Today, we're going to focus a lot on gifts of cash and gifts of securities. That's not to say you can't give complex assets. It's just that right now it may be difficult to facilitate a gift of a complex asset in the few days we have remaining at the end of the year. So, like its old saying says, it wasn't for the last minute, nothing would get done. So again, we'll talk about cash and securities. Let me just talk briefly. Real estate, for many people, it's a great way to make a gift to one or more public charities. By gifting a piece of real estate, you could allocate it to one or more charities. You could give it to your donor advisor and then reallocate that resource. Closely held stock, limited liability companies, limited liability shares, partnership shares, collectibles, antiques, royalties, even cryptocurrencies can be gifted to the Susan Love Foundation. So let's go to the next slide and talk about what's really effective and able this year. Well, those assets, cash, securities, real estate, you name it, there are a number of ways you can make this charitable gift to support the Susan Foundation. Outright gifts. You just transfer those assets and say they're yours. This is for the research that and the wonderful work that the Susan Foundation is doing. At this time of year, we think a lot about family, we think a lot about this year and reflect. And when you're looking and reflecting, a lot of times you're looking at your estate plan, making sure it's up to date. It's no different than your car. Every now and then you got to lift the hood and make sure the fluids are right, the belts are tight. Same thing with your estate plan. You got to take a look at it and make sure does it say what you want it to say. Things you put in, documented, are they still viable for you today? But I would strongly encourage you that when you're doing that review, you might want to consider, and we would ask you to seriously consider including the Dr. Susan Foundation for a percentage of your estate. Again, I say percentages because it's a great way to make sure. You can also use charitable trust. For some people, they're not ready to let go of an asset, whether it's appreciated security or securities or it's a piece of real estate, or you're selling a business. You can gift those assets to a charitable trust, retain the right to receive income for yourself and or an heir or heirs. And at the end of the rainbow, when this trust is destined to mature, that's when the proceeds then go to the Susan Foundation. So again, wonderful vehicle that many people are utilizing today because it's a great financial tool as well as an estate planning tool and philanthropy. There's a number of other opportunities, gift annuities, retained estates, lead trust, whether you want to set up an endowment, or again, donor advice funds, supporting foundations, private. There's a litany of ways, and we'll talk more about that sometime in the spring. So the next slide. What's new for 2020? Well, a lot's new. Obviously, it was a year, it still is a year of rather interesting confliction, but we seem to be dealing with it. I trust you are, and I trust you and your family are well. But Congress did do a couple things for us this year. Remember the CARES Act, which was passed earlier. For those individuals who don't itemize their deductions, you may recall that maybe in prior years you were itemizing your charitable income tax deductions along with your property tax and what have you. But when they increased the standard deduction so significantly, it made sense for many people just to use the standard deduction rather than itemize. And when you didn't itemize, you lost the ability to deduct your charitable contribution. And that's not to say that the income tax law drives your philanthropy. Again, you should support the organizations important to you because you believe in what they're doing, just as you believe what's happening at the Susan Foundation. Your gift is important. If you get to deduct it, terrific. If you don't, it's still of value to you. What they did give you, Congress said, is that this year you can deduct up to $300 an above the line deduction, and that's true to anybody. I don't care if they're filing a single, had a household joint return, it's $300, period, for that return. A lot of consternation earlier this year. People said, well, if I'm filing married filing jointly, isn't it $600? The answer is no, it's $300. It's above the line deduction. So again, you do get some relief, and it's an above the line deduction. Now, on the other hand, if you are itemizing your return, the IRS has increased the limit for charitable deductions from 60% of cash deductions to 100%. So theoretically, for 2020 only, you could deduct up to 100% of your adjusted gross income and effectively not pay any tax. So in fact, the government is paying for part of your charitable gift, because even though you made the gift, you won't pay any income tax. So let's hypothetically say you had $100,000 of adjusted gross income. Were you to make about a $90,000 deduction, charitable gift deduction, you would pay no income tax, or just a few dollars, but you could go up to the full $100,000. What I might suggest is you might consider giving not only some cash, but appreciated securities. We'll talk about that more. But for instance, you had the resources. Again, you want to support the work of the Dr. Susan Foundation and or other public charities, however you want to look at this. You can deduct up to 100% of your adjusted gross income. That's for this year and this year alone. So if the window is open, it's about to close, and you should seriously consider, is this a year for you to do this kind of thing? If you made a gift in excess of the $100,000, let's just say $200,000, You wanted to give 100,000 in this situation would be deductible. The other 100 would carry forward to the following year. It would be subject to the 50 and 60% limitations. So, but that's what's new for 2020. So let's go to the next slide, Bailey. Give long-term appreciated securities. I'm here today to challenge you a little bit, challenge your thinking. I know that for many of you, writing a check to the organization or posting a gift to your credit card for the benefit of Susan Love Foundation works. And trust me, they appreciate that gift, and it may be the right way for you to make a gift. But I'd like to challenge your thinking today and encourage you to reconsider, and maybe you've heard this from your financial advisor and your broker, why not gift appreciated securities rather than cash? Let's just walk you through an example. So gift the stocks, the bonds, the ETFs, mutual funds that are appreciated. In other words, they've been held for more than 1 year. When you make this gift, you get to claim the fair market value as an itemized deduction on your federal income tax return. So what happens here is, let's just say, and I'm going to use an example of IBM stock. And the reason I'm using that example, that's the stock I'm using right now, and a few other little tidbits to make gifts to public charities, taking it on. So if you were to you wanted to make a gift of $10,000 to Dr. Susan Love Foundation, you could look to your IBM portfolio and you could say, gee, if I gave 80 shares, it's trading at about 125, 100 and some change today. If you were to call your broker and say, I want to transfer 80 shares of IBM to the Dr. Susan Love Foundation, and the instructions on how to do that are at the end of this presentation. And we would encourage you that when you give those instructions to your broker, transfer the 80 shares, you also send a note to Dr. Susan Love that I've instructed my broker to transfer 80 shares of IBM to you. That way, when those 80 shares arrive, they know it came from you. So the magic is let's just assume that you paid $25 for those IBM shares sometime back, and today they're worth $125. You've got a significant charitable income tax deduction available to you as a result of that gift. And there's untaxed appreciation in that security that's never been taxed, and it won't be taxed. Let's go to the balance sheet, but it won't be taxed when you give it to charity. In fact, the government says that appreciation has never been taxed. You get to deduct it. It's the magic up to 30% of your adjusted earnings. And for most people, and most financial advisors, they will strongly encourage, it's better for you to make a gift to appreciated property. It's just as easy and simple. The gift in the hands of the Susan Love Foundation or any public charity is the same as if you wrote the check. You can also, if you happen to like your IBM stock, and there's a reason to like it, it's a good stock. I'm not promoting it, but it's a good stock. But it also has a yield in that stock is about a little over 5%. So if you're looking for not only good and solid investment, you got to talk to your broker about this. The reality is that let's say you really like IBM, you want to hold it, you're reluctant to give away 80 shares. Why not give the 80 shares? And then the cash that you were going to make a gift to Susan Love, take that cash and repurchase 80 shares of IBM. You get a new tax base, and you still have the coupon income, and you're no worse off. In fact, you may be better off. It's a great tool, and most financial advisors will encourage you to consider that line of thinking and help you do that. On the next page, so many people are on the fence about itemized deductions or not. With the new standard deduction, many people are just going to stay put because the standard deduction plus the limitation on state and local income tax deductions, it's forced them not to itemize. But sometimes it's close. And so the question is, do I itemize or don't itemize? Well, we would ask you to consider a bunching strategy. A bunching strategy, again, is something your financial advisor might talk to you about. At least I would hope they'd be talking to you about that. And that with the simplified plan, maybe it's been a good year, and maybe you want to make a charitable gift to you this year, and the fact that you get to realize those income tax deduction savings when you itemize, you might want to consider bunching. In other words, making a bigger gift for this year and then skipping a gift next year and or the year thereafter. It just depends. So for instance, if you wanted to make a $30,000 gift to support a specific area at the Susan Love Foundation, you might want to make that gift, whether it's appreciated property, and say to the Student Loan Foundation, "I'm making a bigger gift than my normal this year. So you may not hear from me next year or the year thereafter, but I know that you'll put this gift to good use." And the nice thing is it moves you into a category of itemizing your deductions, and you realize significant tax savings. Your tax bill will go down by doing good. So doing good helps you do better. I know that's not proper English, but the nice thing is you realize the benefits of the income tax section when you make a gift. So consider the bunching strategy. You can make the gift directly to the Student Loan Foundation, or you may choose this bunching strategy and use your donor advised fund as the vehicle for that purpose, giving those appreciated assets to the donor advised fund, and then continuing to make your distribution as you normally would to the Dr. Susan Loan Foundation. It's up to you, but I would suggest to you that this is a strategy you still have time to implement, you still have time to evaluate whether that makes sense. So keep your tax advisor busy. That's encouraging small business. Next slide, Bailey. If you happen to be the chosen few, and that is 70 and a half or older, you have some unique benefits that you can realize by making a gift out of your IRA rollover. So what happens here is, you know that by making a gift from your IRA, otherwise known as a qualified charitable distribution, you can reach into that IRA and you can ask your plan administrator to send up to $100,000 to any one charity. So in other words, you can send it to one charity, you can split it amongst 10 charities. It doesn't matter. You can do the division any way you want. You can go up to $100,000 this year. And again, if you want to do it again in January of next year, you can do it again. The magic is you are lowering the value of your IRA, but you're making your philanthropy through that vehicle, and you are avoiding the requirement of distribution. Now, this year, many of you know, for 70 and a half, they did give you a reprieve this year. You don't have to take your RMD, the requirement of distribution. Let's just hypothetically say your requirement of distribution was $50,000. Instead of taking that $50,000, you get directed to the Susan Love Foundation. And interestingly enough, you don't have to pay tax on that $50,000. You don't get to deduct it either, because it's never been taxed to you. So you never had ownership of it. You didn't have to pay tax on it, but you send it all over. Now, if you had to receive it as taxable income, you might be paying as much as 20, 30, 40% for state income tax. So it reduces the amount you have to spend. And another nice thing about avoiding RMD is for some people with that increased income, it puts them in a different category and their Medicare premiums go up. And the nice thing is, in this case, you can keep your Medicare premiums down. So strongly consider, if you haven't done this already this year, you can reach into your IRA, have your plan administrator send some money directly to the Susan Love Foundation, and the information on where to send it is on their website. But you need to call that plan administrator quickly and ask them to burn the midnight oil and get this done, because time is limited right now in this year. And you cannot make this qualified charitable distribution to your donor advisement. It has to go to one or more public charities, like the Susan Love Foundation. So seriously consider it, not just for this year, but you might want to seriously consider it for next year. Again, you can work with your advisor and determine what's the best avenue for you and what's the best amount to make a gift. So let's go to the next page, Bailey. So charitable gifts to Dr. Susan Love Foundation, they have to be received by the December 31st because of the contribution for 2020. So if you're itemizing your deductions, this is very, very important. So if you're writing a check, you're mailing it to the Susan Love Foundation, make sure that envelope is postmarked no later than 11:59 p.m. on December 31st. So anytime between now and then, no matter when Susan Love Foundation receives that, as long as it's postmarked in 2020, it counts as a charitable deduction for 2020. Credit card gifts. Nice thing about credit card gifts, you go online, you make your gift. As soon as you send that off, that's the day you made the gift. So if this afternoon you decide to sit down and make your gift via credit card to the Susan Love Foundation, your gift counts as a gift today for 2020. If you are taking some of the conversation we had today earlier and considering the gift of appreciated securities, you may say, gee, I didn't realize how beneficial this could be to me, and it's supported by my advisors. Again, you would instruct your advisor to make the transfer of that stock. It's probably too late to get that done today. It doesn't mean you couldn't give the instruction today. It'd be done on Monday, and the stock will be delivered to the Susan Love Foundation. Could be as early as Tuesday or Wednesday. And the nice thing is your gift is made. It counts for 2020, and you've got significant value going forward. But the important thing is to take action because time is limited. At the same time, as I said earlier, if you choose to make a gift of appreciated securities, be sure to share the same instructions you gave your broker. In other words, you may say, I want you to transfer 20 shares of IBM, 25 shares of Microsoft, all of my shares of General Electric, etc., to Susan Love Foundation. Just be sure you tell Susan Love Foundation what you've asked your broker to do, so when it arrives in their account, as you can see later, they know it came from you, and that you'll get the thank you letter accordingly. It's very important to do that. Again, take this weekend to evaluate this process, talk to your advisors, talk to whoever you choose to talk to, but seriously consider acting quickly so that you get full advantage of this. So let me go to the next slide and talk to you a little bit about a strategy that may not be available to you right away, although it could, depending upon how quickly you can move. But this is something food for thought. Converting a traditional IRA to a Roth IRA. Now, your financial advisor may have already talked to you about this. And if they haven't, you might want to suggest we have a conversation to see, would this be valuable? So why would a person consider converting their IRA to a Roth IRA? Well, IRA is a typical way for many people to accumulate assets for their own retirement. And many times they've taken their 401k or whatever plan they had, and they rolled it into an IRA retirement or close to retirement, and that's where they're going to pull to support their retirement. But every dollar pulled out is subject to income tax, depending upon your individual tax bracket. So if you're taking out that money, it's taxable. So always be taxable, whether you take it out or your heirs take it out because you didn't spend it. It doesn't matter. It will be subject to income tax $1. Some people are evaluating the process of why would I convert to a Roth? Well, you might want to convert to a Roth because when you take a distribution from a Roth IRA, it's income tax free. Now, the money you put into the IRA, it's not into the Roth IRA. If you were funding a Roth IRA today and you were putting in $10,000 to that Roth IRA, you were allowed to put that much. You don't get a deduction for it, but all the appreciation on that value will never ever be taxed. You have to wait till you're 59.5 to start taking it out. The magic is no matter when you take it out, it's not taxable. So many people are considering converting their IRA to a Roth IRA. Now to do that, you have to pull the money from the IRA out. It becomes taxable to you, and you deposit the same amount of money into the Roth IRA. Question: how do you pay the tax? Well, you pay the tax for other assets. However, prudent planners might suggest, no, instead of let's do the Roth transfer, let's also look to your portfolio. You've got some appreciated securities here that have tremendous appreciation. If you were to gift those directly to the Susan Love Foundation, you get an income tax section, or if you were to gift them to a charitable remainder trust and retain the right to receive income, either way, you get some charitable income tax section offset in whole or in part the taxability of this Roth conversion. I would strongly ask you to consider talking to your advisor about this process and looking to your portfolio and say, gee, what if I made a charitable gift at the same time I was making this conversion to a Roth IRA? You will find that not only have you done something wonderfully philanthropically, but you've done something wonderful for your own self and or your heirs, because that money comes out of their income tax free. And you may find this is a worthwhile conversion to be making. Some of the people I've worked with, we've made big conversions up front. Others we've planned for the conversion is done over a 3 or 4 year period. So we might convert some of the money now, use the charitable gift and the deduction to offset that, the taxability of that distribution. We can either eliminate the tax or we can get it down to a level that's more palatable. Everybody's different, but it's worth the planning process to go through. So that concludes my commentary, and I'm going to turn it back to Punita, who's going to share some wonderful information.
Well, thank you, Jim, for the informational and insightful presentation on charitable giving options. And include Dr. Susan Love Foundation in your planning. You may transfer stock to the address listed on the slide, and this is the information you should share with your broker. And as Jim suggested, we strongly encourage you to share with the foundation the same instructions that you share. drsusanloveresearch.org/donate. For additional ways to donate, you may visit our website at drsusanloveresearch.org, Ways to Give. And if you would like to get in touch with the foundation about donating, please email info@drsusanloveresearch.org. Thank you, Jane, for the introduction. We appreciate your ongoing support of the foundation. And finally, thank you to everyone for joining us today. We wish all of you a very safe, healthy, and happy holiday season.